Welcome to my course. I'm John Stapleton. This is all about raising investment for scaling businesses. Why can I help you? I started 3 businesses from scratch. 2 of them I took to a successful exit and 1 of them failed. In each business, I raised funds from external sources, both from individual angels and from institutional investors. Following the exit of my 3rd business, I became a sort of poacher turned gamekeeper and joined the investment community. This was initially as an angel investor, over 15 investments, and then I set up an accelerator for startups. And now I'm also a partner in a venture capital fund dedicated to investing in early stage businesses. Before you raise any funds, make sure you think through and understand the following. Being business ready is not the same as being investor ready. Business ready means you have an idea for which you are passionate, have some practical insight, and you've developed a business plan, even a very basic one. Investor ready means you have an investment strategy. You understand the different stages of business growth relevant for early stage businesses. And finally, and this bit might sound really obvious, but it's very important, you have an investable business. Capital scales an engine, it does not create one. There are a number of ingredients for which you need in order to grow a business. You need to understand what these ingredients are and have developed all of them to the extent that your business can't go any further without funding. My way of summarizing this is bootstrap till you know what you're doing and then go big. Investors want risk reduction, not wishful thinking. So if you're pre-revenue, investors don't want to hear you know absolutely everything and that you claim to need their money to implement and grow the business along a predefined path. You actually know very little. At the beginning, you need to make assumptions. All assumptions you make and outline in your business plan need to be tested and proven or disproven. And this is what reduces both uncertainty and risk in your venture. Some key questions to ask at this stage. Why raise funds at all? To accelerate the growth of your business. How much did you raise? What will you use the money for? You need to have a clear shopping list, which, when you spend it and implement priorities, will increase your company's valuation. A key question is, what do I spend the investment on once I receive it? Now, the following are typical items you need to finance through shareholders' funds before the business has its own ability to fund them from cash generated by the business itself. Working capital, stock, team, marketing awareness, and capex. In my experience, an investor is often more interested in your plans to spend on items such as marketing and awareness and team. And the reason for that is these typically drive growth directly. Right, here's a really popular question. Everybody asks this question. How do I value my company? Here's a formula which I think always works. Valuation equals potential times evidence times momentum. Now, of course, you're going to say, that's not really a formula at all, but it works. Let's break it down. Potential. This is you claiming you can change the world. It's all about what is going to happen. It's about what you are going to do. This needs to be reasonably practical, but it is setting the scope for the business and what you and your team can actually achieve. In the early days, potential is all you have. On the one hand, the sky's the limit. On the other hand, you need investors to believe your claims, so you need to justify these claims. Investors are likely to either rely upon or challenge your ability, your experience, or your knowledge, as there's little else to go on. In the absence of any real evidence to support your claims, if you haven't launched your business yet, the emphasis will always be on you, on the entrepreneur. Many investors will discount the claims you make by their own particular margin. In other words, they won't really believe you 100%, or at least they won't model your particular assumptions into their decision making. This stage is often quite subjective and can be based on judgment. Now, evidence is clearly different. As you amass more evidence for your venture by testing or by simply launching your business or launching your product, the conversation becomes more objective. This is because there's more evidence to point you and you are not completely relying on potential. More evidence emerges to support your business claims and the assumptions you make in your business plan. Now, you certainly don't have a complete picture yet. In fact, you never will. But certain elements are emerging. Some assumptions may be disproven, in which case you need to pivot in a different direction, or at the very least demonstrate how you are to take account of this new market information, which, by the way, may be contradictory to your own assumptions. When you get to momentum stage, you will have tested most of your key assumptions, and many have been confirmed as correct. Some you've had to amend as you've been confronted by an alternative reality in the market compared to what you assumed in your business plan. And this will continue throughout the life of the business. But the fundamentals are now much more clear, and the question moves to, this looks like it could work. So how aggressively can you grow this business? You have probably reached break even by now, and you are not reliant on shareholders' funds for absolute survival in any event. But you may need further investment to grow your business. The dynamic is now different. Instead, you may need investment to support an aggressive growth plan or a rollout or international expansion. Different investors focus on different business sectors for their own reasons. Different types of funders will also be interested in your business, depending on your stage of growth. Now, to really understand this, I've compiled a stage-by-stage breakdown of what actually matters to investors at pre-seed, seed, and Series A stages. More info in the PDF attached. Founders who miss this point end up pitching the right story to the wrong room. Let's start with pre-seed investors. So who are these guys? Well, they are mostly angels. They are founders turned investors, and they are early micro VCs. Their mindset is, do I believe this person really understands the problem and the solution, and can they pull this off? They mostly care about the following 5 things: the founder, the problem you're solving, the market potential, early signs of customer interest, and cost structure. Don't chase valuation at all costs. You will appear too desperate, and you will likely overreach. So let's move on to the next stage of investors. These are seed investors. Who are these guys? They are typically seed funds, strong angels, and early stage VCs. Their mindset is this already working reasonably well? And if it is, can it work at scale? Have a very specific plan which demonstrates specific milestones you plan to implement along the way to reaching Series A stage, which is your next investment stage. Detail all the initiatives like team expansion, recruiting key hires, specific growth levers, product refinement opportunities, and brand and marketing upgrades, and improved awareness initiatives. You'll have an opportunity to address all of this because you are now in the market and you can observe how real customers behave. These are the insights and the resources you need in order to hit those all-important milestones enabling you to get to Series A investment stage. Here are some red flags before you get to Series A stage, in other words, why you are still in seed stage. Number 1, vanity metrics. These are impressive looking statistics like total followers or page views that don't really reflect real business success or in any way help with strategic decisions. These metrics are easy to measure and are flattering but lack real context and often lack relevance. More actionable metrics drive performance and growth, for example, conversion rates or customer lifetime value. Watch out for investors who might be an over-reliance on high website visitors but low conversion rates, or lots of social media likes but no revenue generation. Another red flag is having an unclear or a hopeful or a very unspecific go-to-market strategy. This is a primary reason for product failure, due to things like poorly defined target audiences or vague value propositions or even misaligned team efforts. These are more hopeful strategies and they rely on the assumption that a good product will sell itself rather than implementing a structured, actionable plan. And my final red flag at pre-seed stage is the founder is still doing everything. That means, at the very least, you are the bottleneck. At the very worst, it means you are a problem, as you don't recognize you can't carry on being responsible for everything and or taking all the decisions any longer. You really need to get out of your own way and delegate more to individuals who are more capable in specific disciplines than you can ever be. And the final stage of investment involves Series A investors. Now, who are these guys? They are institutional VCs and family offices. Their mindset tends to be, this looks good, but can it become a much bigger opportunity? What they care about most is, number 1, a scalable business model. Number 2, strong evidence of product market fit. Number 3, leadership and organizational design. Number 4, potential for market dominance. And number 5, financial discipline. So what kills a raise? Well, here are 3 cardinal sins that I see a lot of the time from sitting in on early stage business pitches. Avoid these 3 sins and you'll be well on the way to receiving an I'm in from investors. Number 1, most startups fail one test before the investment pitch even starts. They say or they think, we'll figure out the distribution once we get past the raise. Now, if you can't show a repeatable way to get customers without burning huge amounts of energy or time or money, your problem is not funding, your problem is selling. Number 2, the founder is certain and doesn't ask or listen to the customer to find out what they actually think. Founders who are certain or show zero doubt usually fall into one of 3 categories. They haven't tested enough, they ignore the data that contradicts their plan or their view, or they're emotionally attached to being right. You don't need any of those approaches. I'm far more interested in founders who say, this is our best guess based on the evidence we've gathered so far. Here's what we're pretty sure about, here's what we have a good hunch about, and we're planning to test that, and here's what we're still winging it about. We don't really know. And they say something like, we'll get to this bit later because it's less important than the other stuff for the following reasons, but we have a plan to figure it out because we can't go forward without figuring it out. And the third is claiming you want smart money but not listening when you receive the advice. Now, some founders simply cannot take advice. They claim they want the value-added smart money that angels bring, but in truth they believe they have it all figured out already and they're not interested in what other investors have to say. Most startups don't die because they failed to raise funds. They die because they never learned how to sell. Investor money doesn't fix that challenge. If this is a fundamental flaw in your business, investor money just delays the day of reckoning until later. So make sure you can sell, and you are already selling well before you raise, and be clear you need shareholders' funds in order to sell more and then to scale your business. The fastest way to lose investor interest is certainty. Investors don't back certainty. You can never really have certainty. And you can never have certainty at any of these three early stages. Good investors back founders who update their thinking faster than the market changes. So thank you for listening to my course on raising investment for scaling businesses. I hope it's helped. I hope you've learned something. And make sure you're subscribed so you don't miss out on the next free course.